All right, guys, we're back again with another great episode of PFREI. I'm your host, Fuquan Bilal. We got another great guest on the show, Lane Kawaoka. All right, so I'm going to read your bio real quick. So Lane has been investing over the last decade, and he's now controls 2,600 units. So we're going to get into that. A lot of work involved with that. Now, as the owner of crowdfundaloha.com, simplepassivecashflow.com, and realaloha.com, Lane is responsible for finding investment opportunities, analysis, and marketing. Now, Lane obtained his bachelor's in industrial engineer and his master's in civil engineering and construction management from University of Washington. Now, in addition to an analytical engineering background, Lane has real-world experience, all right, in working as a project manager for over $230 million of capital construction projects in both public and the private sector. Now, working as a high-paid professional in corporate America and frustrated by the traditional wealth-building dogma, Lane was compelled to inspire and mentor other working professionals via his Top 50 investing podcast at simplepassivecashflow.com. I got to get on that podcast. So I see in the background there, Top 50. So the first question I always ask the guests is, why are you passionate?
Oh, what was that again? Why are you passionate?
Exactly. Why are you passionate for real estate investing?
So I quit my job probably about 6 months ago, and now my life has finally started. And I think everybody deserves to feels what it feels like to not have to go and work for the man, or you have a life of choices and abundance.
Freedom.
Right. I'm not retired or going golfing, but I get to work on projects that honestly I haven't really figured out what the heck they are. Maybe we'll catch up next week and we'll talk about some like worthwhile projects. But now that I freed myself, and it's all possible through picking up rental properties one by one in the beginning.
Yeah, so it's 4 years, you said, right? You said 4 years? You picked up 6 months ago, and you've been the 2,600 units. Let's talk about that. How did you go from getting started to managing that many units? Because that's a lot for if those are multifamily, so you have a couple of 100-unit buildings and bigger 300-unit buildings and stuff like that. We'll get into the geographical areas where those are located. But let's just talk about that for people who want to know a little bit more about your background. We talked about a little bit of the bio, but when you got into the real estate, how did you scale up to that many units?
Yeah, so I started investing in 2009, bought my first property in Seattle, and from 2009 to 2016 I had 11 properties. So what I tell people all the time, it's like, the big number sounds impressive, of course, but I mean, it was a grind getting all the way up to 1 to 11. But going from 11 to now over 3,000 just in the last few years, that was the easy part, right? This is compound interest.
Yeah, the toughest part is getting started, building a track record, people knowing you do what you say you're going to do, and then the opportunities to start flowing from there. So we're both a part of the same mastermind group, Collective Genius, and I like that group because it gives you the opportunity to leverage the brain power that's in the room. How has being a part of mastermind groups, not that one in specific, helped you grow your business to the next level? What type of resources do you pull from those individuals there or that group as a whole, that brain power, to implement into your business to get to the next level?
Yeah, I mean, it's everything, right? I mean, if not, why would we all pay 25 grand to be a part of a group that 4 times a year, right? It's for most people, that's ridiculous. It's absurd. And I would say that's completely ridiculous if you found me 5 years ago.
Yeah, me too. Me too. Now I'll pay it up front.
Yeah, yeah. And you just know you're going to get the value out of it. But, let's kind of walk through this. I mean, I have a saying that I've been kind of thinking and telling a lot of younger entrepreneurs is, they say your network is your net worth. And the biggest mistake is these guys, when they get started, they just start networking like crazy. I'm like, hold up. I don't think that really applies to your net worth, or your business gets moving, or your net worth gets to be above $500,000. If you're broke and under $500,000, you got to grind. You got to get 11 rentals or one rental. I think at that point, there's a transition point. And I think Grant Cardone says, he says the threshold is $100,000 of capital ready to go swing at the bat. At that point, the network becomes way more important than hard work. And I think when I first started, I just listened to the free podcast, bought rentals, and it took me from almost 10 years to get up to 11 rentals. But at that point in 2015-16, I haphazardly started to join groups, and the first one was like $5,000 a year, and then the next one was $20,000 a year. And now I don't blink an eye when I join Collective Genius. I get it. I get it. I mean, I'm at a point in net worth and my current network where I can leverage what I've done in the past into this other group and just take it that next step further.
Yeah, I think definitely is important that when you play at a certain level, you need to have that brain power in the room to help you navigate through some of those challenges that you may be overcoming, that you're going through to overcome it. For me, it was, and I mentioned this on a few podcasts, my biggest challenge was scalability, having the right systems in place. And the bigger you grow, the more capital you raise, you're always going to make sure that you have the right system in place. And I know you probably read this book already, Traction. It's a really good book by Gino Wickman, and basically that and What the Heck is EOS, and a few other books that I was able to get from a few masterminds that I attended, just really showing you how to refine the process so you can scale. Because there's three things you need, in the business to be successful, and that's the capital to buy, the inventory to buy, and scalability. That's my opinion, to go to the next level. So let's talk a little about the markets that you're in. What markets are you, that are you in with the multifamily stuff? And you're not doing any single families, just all multifamilies?
Well, I'm trying to unload my single family homes. Last year I sold 7 of them. This year I sold 2. I've got a couple less I want to try and unload and retap that equity into better leverage assets and value add. But location wise, I like the southern states better. The drivers are population growth and job growth. I don't know which leads the other. I don't really care, but that's where the rent increases are steady. So if you kind of draw a smiley face on the southern part of the states, mostly on the eastern side, because you stay away from primary markets like California, of course. But properties at cash flow day one is a big thing for me. So those are a lot in your secondary and tertiary markets, and then on the southern side, because that just seems to be where the population growth. And again, I invest after workforce housing, so it's always the blue collar type of jobs is what I'm looking for.
Yeah, that seems to be the common thing for most of the multifamily investors. The southern states, southeastern states, call it workforce area.
Yeah. It depends on your business plan, right? I mean, at the end of the day, what you're trying to do is you're trying to increase the net operating income, increasing expenses, decreasing, or increasing income, decreasing expenses. I mean, you can do it a variety of ways. You can go to California and you can go negative cash flow and put 10, 20 grand into a unit and then pop the NOI and increase your value that way. Me personally, I just like cash flow while I'm doing this. So that's why I do what I do. But each to their own. I mean, whatever your means to bump the NOIs, you can do it a variety of ways.
Unit value. Are you doing any Airbnb out of your units? Are you leveraging?
No. Most of these are like Class B and C. Although I do have one Class A apartment near Dallas, where it's a prettier asset. It's A class. Very unique loan that we got because we inherited some of the low income restrictions, so we increased the leverage, so it was able to get the returns that the BC rentals have. But we have some it's near a government contractors, so they have interns, so they'll come during the summer and they'll we'll charge them a higher premium. But I mean, the investors love that, but I keep telling them, like, these are the properties that, in my opinion, they're not as strong through a recession, like your B and C class. But man, gotta love those short-term rentals. Like, when it's good, it's good.
Yeah, we've actually in our area people are doing it in a C class, surprisingly, in some of the C minus class areas. People are, local people are coming from out of town visiting their family, looking for places to stay cheaper than hotels. And I was pretty surprised when I saw, landlords, and this in a 3-family properties in C class areas, were getting high rents for high short-term rentals. And I was like, wow, that's great. Able to get a hold of that market and make a profit. Let's talk a little bit about when you're with the multifamilies. Like, so what are the challenges you run into? Is it finding great opportunities now still in the marketplace? Because like everybody's chasing multifamily deals. Is it the resources you've built over the last since 2009 that you still have stuff coming in, or you have a great marketing plan out there that's driving deals to you? What are some of the challenges that you run into in that sector? Because it's on fire now. Everybody wants to get in. So how are you staying competitive with your offers and finding an opportunity?
Yeah, so I mean, I'm a little bit different. I'm not the one talking to brokers. I'm not putting in offers. I wait till these hardworking syndicators and apartment operators go find the deal, and then I just jump on the deal myself. So I don't know I don't know if this is a good example because not many people have watched the movie, but like I watched the Solo movie, the Han Solo movie. And remember the villains, they just wait till Han Solo gets the thing and go steal it from him after. That's essentially what I do. And I know a lot of syndicators, so I just kind of cherry pick the good ones and then jump on the deal. So that's why I live in Hawaii. I mean, I try to do things the easy way. So I don't know. I don't know how to go market for off-market deals. I don't know how to do that. I just know all the syndicators, and I just luckily I know how to underwrite the deal, so I can decode the code and cut through the noise. And there aren't many good deals out there. Everybody's underwriting it a little more aggressively than they should. But I'm just trying to pick the best out of the group and just kind of dollar cost average my way to build a syndication ladder as I go into a deal every quarter or so.
Oh, interesting. That's definitely a good approach, because a lot of people are hands-on, out there scouring the streets for deals and going through
Yeah, that's why it's simple, passive cash flow. It's pretty simple and it's kind of passive.
Great title for it. So the whole concept of it is to find a deal where you can get in from a syndication, like a sidecar joint venture type, and you can kind of ride the wave a little bit with an equity piece.
Well, at first, I mean, am I going to invest as an LP first? That's the first question. If I'm not going to put my own money in it, heck, I'm not going to put it out to my folks. No way.
Absolutely.
And it's skin in the game. And the way I present it is, hey, man, I'm going into this deal myself. I've ran the numbers. I like the person. If you want to come, you can come. You do your own due diligence. But here are the reasons why I'm doing it.
Now, are most of these set up where there's an equity piece, or, I mean, it's pretty much, I've seen some set up where there's just debt, but the majority of I've seen set up where there's equity, there's a pref plus equity with a nice term once they go and do the value add and they put it on the market to capture that equity piece. Is that pretty much the structure?
Yeah, I mean, I only want equity deals, right? I mean, to me, I want upside, right? I'm not just going to put my money in and just get a straight return. And there's all these different ways you can cut and structure a deal. They'll usually, just to kind of talk in generalities, like the percentage split between general partners and limited partners. To me, I like to go into deals that are about 80-20, 80% going to the LPs, 20% going to the GPs. I think that's pretty fair. But as you get to more institutional operators, the ones that have a longer track record, they usually have a little bit heavier fees, acquisition fees, and they have a little bit better split for themselves in terms of they might go down to even a 50-50 split. on profits. So
Yeah, that's interesting. So the simple passive cashflow.com, is this something that you created to bring more awareness to the market here in the US, basically to educate passive investors on how to essentially ride your coattail on what you're doing in deals, or how to get in on deals the same way you are, so to speak?
yeah, so initially I made the podcast back in 2016 as a means to just like not repeat myself 100 times, because at the time I was buying like these turnkey rentals, and I thought these turnkey rentals were like the bomb, right? Like, you buy a house, they have a tenant in there, you don't do anything, right? I mean, that's simple passive cash flow to me at the time. But as I got to double digits of these things, I realized it wasn't scalable, and that's where I found the syndication. So all my buddies were asking me like, how is buying all these properties in Birmingham, Atlanta, or wherever, and I don't even visit the properties, and it's real estate, and this, nobody does anything, right? Everybody asks questions and saps your time, especially your friends and family, right? So I made a podcast for them to go listen to, and many of them didn't. But when I put this podcast out there, a lot of people in the world would use it. And like a lot of the beginning podcasts are all about turnkey rentals and building a portfolio slowly. But the story has kind of changed, obviously, right? So I kind of just journal what I do personally in that podcast. But
Yeah, that's awesome, man. That's awesome. So the turnkey business is still lucrative. There's active operators that are out there. You have active build operators, and you have the passive people, right? The passive people bring the capital, get an equity piece, or get a debt piece, whatever it is. And the active guys are still out there, quote unquote, crushing it, going through all the property management issues and everything else. I know a lot of people in our group actually that's doing turnkey. That's very successful at. I guess it just depends on what level you want to be at with it. But I can see what you mentioned as far as scaling, the multifamily being a better opportunity, a better vehicle for that. Is that something that you experienced once you had a taste of that and saw that it was a little bit more scalable and less active, meaning dealing with all of the day-to-day things that the turnkey guys go through with property management, eviction, turnover?
yeah, for me, like, this, my advice, I work with like high paid professionals, right? Like if you make under 50 grand a year, don't listen to me whatsoever. But if you got a pretty good paying a job, you're engineer, doctor, lawyer, um, like turnkey rentals are a great way to get started. Buy a few, learn it, especially, you get comfortable with it, right? And it's not in your backyard. It's not in the state you live in, like most likely. And you get comfortable doing that. But as your net worth grows to be $500,000 or more, it's just not scalable to have these rental properties all over the place. And it's high liability. At that point, it becomes more of an issue of scale, and it's probably better to take back, not be in real estate, but to own the businesses or the LLCs, the syndications that own the real estate, and you get all the same tax benefits, probably even more because of bonus depreciation, cost segregations. And but I've been known to be wrong before, right? I thought turnkey rentals were the best, but hey, man, this is what I'm doing, and like, I'm learning, but
Yeah,
the key, right? Like going back to the mastermind thing we were talking about earlier, like, man, I didn't really start to take off until I got into a room with people of my same pedigree, doctors, lawyers, engineers, and people who are 10, 20, 30 years older than me on that path. That was key. And just like, why we joined Collective Genius, right? These entrepreneurs that are similar to us, but just a little bit further down the road, right? That insight is invaluable.
absolutely. I mean, the whole process is what you're going to give, and then what you need. And they have, oh man, from so many years of content that they put together, it just definitely help you be able to source the resources and structure deals, or your office setup, or things that you need in place. So eternally grateful for that. Now, what are, and I always ask the guests this question also, the challenges. Let's talk about that because we're all human. We all face a challenge. That's why we all are part of groups to help us overcome challenges. What are some of the challenges you're having in your market? And what are you doing for 2020, the next decade that's coming in 2020 to kind of overcome that? Like, for me, as I mentioned, it was scalability, and I put processes in place and systems, and we're constantly refining and process mapping so we won't run into a bottleneck of certain things. What are some of the challenges you're facing in your market?
Yeah, so I'm still trying to unload my last couple rentals and then replace that equity into fresh deals, because I feel like investors, it's a big thing on return on equity. You know, initially when you go into a fresh deal, you're making good returns, but as your equity position goes up, you should re-leverage your deal, either cash out refinance or sell the asset and go to the next one. So I'm still 2020. I'm still, transferring assets and equity into new deals. But like everybody says, the cap rate compression, deals are harder to find, yada yada. And there's still deals out there if you know how to decode the code and underwrite deals yourself. But maybe after 2021, I might be pretty good, right? Like I'm pretty frugal, so I don't really need that much money to survive. So what I'm thinking of maybe going to lower risk, lower return type of deals, maybe like settlements or just a lot more like uncorrelated with the economy type of assets.
Good. That's good. That's a good point. I actually invest in mortgage notes. So, and I do some rentals also, but it's a diversified hybrid real estate investing approach where I'm able to get real estate at a discount through tax liens on properties, and I buy defaulted mortgage notes from the banks. So, have you actually? On the other side, but I know some of the operators try to look for tax liens that are foreclosing and take those over and foreclose on the properties as well. I don't. There's some people who's doing that, but I don't know which markets is that like really hot in, going on that.
I mean that's the tenants are like what's simple and what's passive, right? Like to me, that sounds like lot of hard work. I mean, great returns, don't get me wrong, but a lot of hard work. Um, I think for me, the equivalent of something like that, as you go lower on the scale of returns and risks, would be like a triple net, like a Walgreens or something like that.
Yeah.
Because if people notice what I'm doing these days, like I know apartments the best, and that's still what the lion's share of my portfolio is. But I am slowly migrating over to mobile home parks, which is a little bit less frothy type of asset and a little more cash flow based.
Real estate. Real estate.
Yeah, you don't own the property. The tenant owns it. So if they screw it up, that's their own fault. You just own the concrete slab underneath.
Yeah. I had a guest that did mobile home park investing, and he's actually a part of Glenn. He's a part of the group.
Oh yeah.
And it's a lot of experience and everything there, and that's like his one focus, really high return. So yeah, mobile home park is definitely something that everyone should look into. I think that's the best kept secret. One of the biggest secrets people don't know about because they just think it's a van on a piece of land and not really like a home, that you can actually take a loan against or borrow against and stuff like that. I think it's a title or registration or something like that instead of a deed of trust.
Right. And I think you also have to look where all the dumb money is going, right? I mean, look, there's so many multifamily apartment guru groups and podcasts. I mean, you always have to figure out where people are going and try and do something a little bit different. Zig when everybody's zagging is the saying.
Yep. But yeah, man, I definitely thank you for sharing your knowledge and wisdom with the group and coming on the podcast. This is another great episode, multifamily investing, mobile home park, and a lot of great discussion around that. Let's give a plug where people can reach you or find more information about you. I know you have the simplepassivecashflow.com. You want to give some more plugs or other information?
Yeah, I mean, if you're looking to do like turnkeys, I would suggest listening to the first 20 of my podcasts, and then I have a passive investor mastermind. So, I always say the best thing for passive investors is to find other high net worth accredited investors to network with. Unfortunately, they're not on the internet forums or the meetups, right? I mean, those are just the broke guys. Let's be honest. So you got to get around, like you got to join masterminds and level up accordingly.
Yeah. Thank you for coming on the show, man. I really appreciate it. Another great episode.